All right, let's get straight to the point. Something significant is happening right now in the precious metals market that most people are completely overlooking. Silver has finally broken out of that stagnant range where it seems stuck forever, and the relationship between silver and gold is flashing a massive pressure signal. This is the exact kind of setup that has historically preceded some of the most violent blow-off moves we've ever seen. I'm telling you clearly, this window is tightening fast. If the bond market makes even one wrong move, the next leg of this rally could start within hours. Most investors are making a classic mistake. They are staring at the nominal price of silver as if that tells the whole story. It doesn't. The real narrative is found in the spread, how incredibly cheap silver remains when compared to gold. Historically, when this spread snaps back, it doesn't do so gently. It happens with extreme force. If you wait for the mainstream media to confirm the trend, you'll do what the crowd always does. You'll buy at the very top. Or even worse, you'll see a minor indicator scream overbought and sell your position right as the real move is just getting started. For decades, silver has traded within a specific percentage of gold's price. In boring years, it stays in that band. But in a true bull phase, that ceiling disappears. Silver stops acting like a polite industrial commodity and starts behaving like a coiled spring that has been held underwater for too long. Even after the recent price action, silver is not expensive. Relative to gold, it is still historically cheap. This is why the coming move can be so brutal, in a good way, because it's not starting from an overheated position. It's starting from a massive discount that hasn't been corrected yet. Now let's address the elephant in the room. People love to talk about market manipulation and suppression. Whether you believe in those theories or not, it doesn't change the fundamental math. When sustained global demand meets a constrained and limited supply, pressure builds. When markets ignore that pressure for too long, the eventual release is loud and fast. It usually happens at the worst possible moment for those on the sidelines, when late buyers are hesitating, looking for certainty, only to realize the price has already run away from them. What makes today different is that silver isn't just a panic asset anymore. It is now deeply embedded in the physical infrastructure of our future. Think about power systems, advanced electronics, high-density computing, and the massive upgrades needed for global energy grids. Silver is a core component in all of this. It's not an optional luxury. You can't just swap it out for something cheaper without sacrificing performance. This means the demand is real, structural, and constant. On the flip side, supply doesn't just magically appear because the price went up. Mines take years to develop. Years of low prices have led to less exploration and zero spare capacity. When the world suddenly realizes it needs more silver than can be produced, the market doesn't adjust calmly. It undergoes a violent repricing event. Looking back at prior bull runs, the silver to gold ratio didn't just drift, it exploded. It has doubled from depressed levels in the past, reaching heights that seem ridiculous to people anchored to normal prices. But bull markets don't care about what feels safe or normal. If gold continues its upward trend and silver simply returns to its long-term average, that alone is a massive move. But what if silver doesn't stop at the average? What if it does what it has always done during true bull cycles and pushes well beyond? That is where the parabolic candles come from. That's when people wake up and wonder how the price moves so far, so fast. The answer is always the same. It was undervalued for far too long. This brings us to the psychological trap that ruins most portfolios, the overbought panic. You see silver surge, your screen flashes red on a momentum indicator, and you convince yourself the move is over. In a normal market, that logic might save you. In a monster bull market, that logic will destroy you. In historic surges, silver has stayed overbought for months, not days. If you sell at the first sign of a peak, you aren't protecting profits. You are volunteering to miss the entire run. You'll end up watching from the sidelines, trying to rationalize why you were right while your portfolio proves you were wrong. Instead of treating this like a quick trade, you need to view it as a regime change. This doesn't mean being reckless with leverage. It means refusing to let weak signals scare you out of the strongest setup in years. Imagine gold continuing its steady march higher. Silver, still at a discount, begins to play catch-up. At first, it looks like a normal grind. Then it hits the old resistance levels, the historic highs that everyone thinks are impenetrable walls. Instead of retreating, it smashes through them. That is the moment the narrative changes and the speed accelerates. Once a market exits an old range, it doesn't return to the middle. It does years' worth of movement in a matter of weeks. It's not irrational, it's overdue. The real fuel for this fire, however, is sitting in the bond market. This is the part people find boring until it suddenly becomes terrifying. Government debt is the foundation of the global financial system. Pensions, banks, and insurance all rely on it. When that foundation wobbles, the response is always the same: emergency liquidity and more intervention. But if policymakers have to constantly step in to save the system, what does that say about the value of the currency? Holding paper promises becomes a massive risk, while holding real physical assets becomes the only viable strategy. Gold and silver are the purest expressions of this shift. You don't need to predict the exact day the bond market cracks. You just need to see that the risk is rising, and the consequences of printing money to fix it are always the same. It debases purchasing power and causes real assets to reprice upward. Let's also clear up a common myth. The idea that if the stock market falls, metals must fall too. While a sudden crash can cause everything to be sold briefly due to margin calls, history shows that gold and silver often recover much faster and can even rise while stocks are still bleeding. The biggest moves in metals happen when confidence in paper assets is shaken. Markets can stay complacent for months while internal stress builds, but when the support finally cracks, there is no warning, only a scramble for safety. That scramble is what fuels the next leg up for silver. Silver is volatile. If it runs hard, it will pull back hard. That is the nature of the beast. The mistake is confusing that volatility with failure. When silver sprints toward a new high and then snaps back, the experts will scream that the move is dead. But in a shifting market, those pullbacks are resets, not reversals. They flush out the weak hands and prepare the market for the next leg higher. If your plan is to buy and then panic sell at the first dip, you are just donating money to the market. Success comes from positioning with intent and holding through the noise. We are currently in a window defined by two massive forces, silver's extreme undervaluation and the fragility of the global debt system. When these two align, price moves begin abruptly because the last seller vanishes and buyers are forced to chase the price. Imagine three scenarios. First, gold stays steady and silver returns to its average. Huge move. Second, silver overshoots that average as it has done in every major bull run. Even bigger move. Third, the bond market stumbles, leading to aggressive currency creation. This leads to a violent overnight repricing. All three are plausible, and in a world driven by capital flow, you don't need a guarantee to see a massive shift. The old reality for silver was built for a different world, one with different technology and less financial stress. If you are using an old map to navigate this new market, you are going to get lost. If you aren't positioned for the next several months, you might miss the most explosive phase. The early phase feels uncomfortable because it feels too late, even though it isn't. The middle phase is where the debate ends and the stampede begins. You can see this transition by watching how pullbacks behave. In a weak market, rallies fail. In a strong market, every dip is aggressively bought. If you are waiting for a date or a specific hour to enter, you are looking for certainty that the market won't give you. What the market is giving you is a massive signal. If long-dated government bonds start to slip and yields spike, the reaction from central banks will be more rocket fuel for metals. Silver, which is still trading at a discount, will move harder and faster than gold when that happens. Even if silver spikes and then retraces, the floor is moving higher. Every cycle starts from a higher base, which is how long-term wealth is built. Ask yourself this. If silver runs to a level that seems crazy today and then pulls back, would you feel smart for being out or sick for missing a long-term shift because of a short-term dip? The winners are the ones who have a plan before the emotions kick in. Separate your holdings into a core position that you don't touch and a tactical position for managing volatility. This way, you aren't forced to be all in or all out. You can ride the wave while still respecting the risk. The biggest mistake you can make right now is not being there when the move starts. The first burst can cover months of progress in just a few days. If you're waiting for a dip that never comes, your discipline will quickly turn into regret. The next candle can start before you've even finished your morning coffee. Are you convinced silver is still undervalued, or do you think the move is already priced in? If there is a sharp pullback, are you the type to panic or the type to recognize an opportunity? To wrap this up, we are looking at a market where silver is historically cheap, demand is structural, supply is capped, and the financial system is leaning on intervention to survive. This doesn't mean a straight line up, but it does mean a massive upward bias. What happens next will either be a steady grind that resets the market without drama, or a sharp run that forces a fast revaluation. If it's the latter, it won't be comfortable. It will be fast. Stay focused on the spread, watch the bond market, and don't let the noise of the crowd distract you from the biggest setup.